So to get us ready for class, I want to talk about materiality. Now, we covered materiality high level in chapter 1, but in this video, we're going to start going a little bit deeper. And when we're together in class, we're going to talk more about the mechanics of materiality and look at a specific example. So, again, to recap, first I want to cover what is materiality, and then second, we're going to talk about why do we use it. So, first off, again, this was covered in chapter 1. It is the amount by which the financial statements can be misstated without affecting the decision of a reasonable user of the financial statements. So to put this into context, you can think about Walmart. They have billions, like hundreds of billions of dollars in revenue. And so a $10,000 transaction to Walmart is likely immaterial. That is not going to change the decision of somebody using those financial statements. But to bring it down, my mom has a small computer software business, and $10,000 to her would be material. And so materiality is something that we cannot apply across the board. It's going to be set by the auditor's judgment based on various factors relevant to that client, the risk, the industry, the amount of revenue, etc. And so it's an amount, it's a dollar amount, but it changes depending on the client. And then the second thing that I want to talk about is why do we use it? And the first is that it is a guide for audit planning. Once we set the materiality level, we are able to then dictate what areas and what type of tests and how fine of a testing level that we need to do. And then the second thing is that it is a tool for evaluating misstatements that we detect. So if we find an error in an account balance, something that's on the balance sheet, or if we find an error in a transaction, then we can decide, is this material or not? Does this point to a greater problem that we need to dig a little bit deeper? So it's a guide for our planning to hopefully get us to the end of the audit. And then second, once we're in the midst of the audit, it helps us determine whether something that we find is okay or if we need to go deeper. So two elements of materiality that you need to be very familiar with before you come to class is, the first is overall materiality. And so this is the materiality threshold for the financial statements as a whole. This is the maximum amount that the financial statements can be off before they're going to change the user's decision. So if the financial statements are misstated by more than whatever our materiality level is for overall, then we have a problem, and management needs to record a correction to the financial statements before we as auditors could give them a clean opinion. Otherwise, we have misstated financial statements, and nobody wants that. And the audit standards are pretty explicit about this process and how auditors are supposed to use materiality. So you could go look at the PCAOB audit standards 2105, and you can see the topic about how auditors need to consider materiality in the planning process and the performance of the audit. So we use materiality, as it says in this paragraph, to plan the nature, timing, and extent of our procedures. So it's planning, and then again, like I said, we're going to use it as a tool. So that's the first thing. One, you need to be familiar with what is overall materiality, and that's the total amount at the financial statement level. The second thing, and this is where it gets a little bit more complicated, and I'm planning for us to talk more about this. So if you have questions, that is good, and I want you to bring them to class, because this is something that's important that you need to understand, and that is tolerable misstatement. Sometimes this is called performance materiality. And so this is the materiality threshold at the account balance level. So I have overall materiality for my financial statements, but then remember, our financial statements are made up of various accounts. So we have cash, accounts receivable, inventory, and then we have our income statement accounts. We have revenue and expenses. And our tolerable misstatement is derived from our planning materiality. And it's usually equal to about 50% to 75% of our overall materiality. So let's say our materiality threshold was $10,000, and then my tolerable misstatement could be 5,000 or 7,500, somewhere in there. Again, it's a judgment call, and the plan or the tolerable misstatement for different accounts might vary based on how risky those accounts are, how complex they are. So, and we're going to spend more time talking about that when we are together in class. Now, it's important that our tolerable misstatement is always less than planning materiality. So it's never going to be like 110% of overall materiality. It's always going to be less than 100% of planning materiality. And so something that is important, and this is where I expect you to have questions, which is good, and that is that our tolerable misstatement, let's say we set it at 50% of overall materiality, our tolerable misstatement in sum, when I consider all of the financial statement accounts, because if you take 50% for cash and 50% for accounts receivable, well, then you add that together, and that's already 100%, but I haven't even audited inventory, I haven't audited property, plant, and equipment, any liabilities, equity, revenue, or expense accounts. So why is it that I allow tolerable misstatement in sum, the sum when I add up all of the tolerable misstatements for my various accounts, to be greater than my overall materiality? And we allow that to happen for a couple of reasons. And the first of these is that not all accounts are going to be misstated by the full amount. Okay, so we want to set our tolerable misstatement level in such a way that it's going to catch misstatements that might exist in an account, right? So we want to set a fine enough filter, but it's not likely that all of the accounts are going to be misstated by that amount. If we find a misstatement and we don't ask management to correct it, then we will we have to document that, and we are going to do an evaluation at the end of the audit to make sure that anything that was uncorrected in sum does not cross overall materiality, because then if it does, then we need to go back and correct it or ask management to correct it. We as auditors do not correct it. The second reason that we would do this is that typically auditors are working on multiple parts of the audit all at the same time. If I, started with cash and I just moved my way through the balance sheet and I was the only one doing the audit and I did it all in sequence, then I could take any leftover amounts of materiality and move it forward. So if cash wasn't misstated at all, then I still have all my overall materiality to work with. But that's not the case. Somebody's going to be working on cash, somebody's going to be working on inventory, somebody's going to be working on the liabilities, somebody's going to be working on revenue, and somebody's going to be working on expenses. And so because we're all working at the same time, we need to have this amount of materiality that I'm using, and I'm asking questions. So that's the second thing. Then materiality as a percentage of our really large accounts like inventory or property, plant, equipment is likely to be very small. And so if it's too small, then we're just going to end up doing too much auditing. And we've already talked about how we don't have enough time in the world to test 100% of the accounts. And so I have to set my planned level of testing to be something that allows me to effectively audit, but also be efficient about my auditing and collect sufficient appropriate audit evidence. So the goal is to get it into that sweet spot that's going to detect misstatements if they're there, but not do too much work. Because again, we're only engaged to provide reasonable assurance. And so we've got to find that sweet spot. So again, it's a learned practice to set this judgment call, which firms provide a lot of guidance. So don't feel like you're going to have to do this on your own when you're out in the world. If we were to detect a misstatement, detect a misstatement, then typically we do additional procedures. So if I find something that's a problem, then I'm going to start digging deeper. So it's not like I find that problem and I just move on. No, we always do extended procedures if we find a problem. And materiality is really just a safety net. So if I find a misstatement, I have to accumulate it, I document it. And if I don't ask the manager to correct it, then we're going to accumulate that, we're going to review it, and at the end, make sure that the financial statements are all fairly stated. So those are some reasons why tolerable misstatement in sum, when I add it up across my accounts, is allowed to be greater than overall materiality. And I hope that you come with good questions, because we're going to talk more about this as we look at a specific example about how to calculate materiality and how to assign tolerable misstatement to various financial statement accounts.